I'd like to continue the discussion of foreign exchange by talking about managing foreign exchange exposure. There are three types of foreign exchange exposure: accounting exposure, transactions exposure, and operating exposure. Accounting exposure is the risk that the accounting performance of the company will be adversely affected through the translation into the home currency of foreign currency assets and liabilities, and through the consolidation into the home currency of foreign currency subsidiary accounts. Transactions exposure is a cash flow exposure. It's the risk that foreign currency denominated cash flows, when translated into home currency, will be adversely affected. But we're talking with transactions exposure about contracted cash flows that are typically occurring within the next few months to a year. Operating exposure is a much longer term concept. In fact, it extends throughout the entire life of the company. It's the risk that the home currency value of future expected cash flows will be adversely affected by unanticipated foreign exchange price changes. And those expected cash flows continue throughout the entire life of the company and contribute to the company's value. So we're not going to talk about operating exposure until I talk about net present value. Today, I'll just be talking about accounting exposure and transactions exposure. First of all, accounting or translation exposure. Translation exposure is the risk of losses in the financial statements of a company when the assets and liabilities denominated in non-local currencies are subject to adverse changes in exchange rate movements. Whether the company has subsidiaries overseas or not, it may have monetary assets and liabilities. If these monetary assets and liabilities are denominated in foreign exchange, then they will be translated at the spot rate on the balance sheet date, and then the gains and losses associated with these changes in the value of those monetary assets and liabilities will be reported in the profit and loss accounts. Whether the assets are monetary or whether they're property, plant, and equipment or working capital requirement, all of the assets and liabilities of a foreign domiciled, foreign currency based subsidiary consolidated into the company's accounts are consolidated by a method called the current rate method. The current rate method, in general, translates all of the assets and liabilities of the subsidiary at the spot rate on the balance sheet date. If this process of consolidating foreign currency denominated subsidiaries' accounts into the parent company leads to foreign exchange gains or losses, these gains and losses do not go through the profit and loss statement. They're debited or credited directly to equity through something called the Statement of Comprehensive Income. So let's look at the accounts of GE. GE has many subsidiaries located all over the world, and as you can see by this statement of comprehensive income, the translation or accounting gains can be considerable. So this first line is the net earnings. That's from the profit and loss account, and then we make several adjustments. The adjustments come from investment securities and from pension benefit plans, but two of the adjustments are related to foreign exchange. And here we have currency translation adjustments, and here we have cash flow hedges. So these are hedges that were set up to offset these cash flow adjustments. And you can see that the number $2.729 billion US is considerable. At 18% of income, this is something that management is likely to worry about. Alibaba's foreign exchange translation exposure comes from exposures that are not associated with consolidation of overseas subsidiaries. It comes through direct asset and liability accounts. If we go to the red herring prospectus, page 103, we can see under interest and investment income the footnote, our net interest and investment income decreased by 84.9% from renminbi 258 million to renminbi 39 million. And they go on to say that that's mainly due to foreign exchange losses. But in 2014, Alibaba radically changed its translation exposure, and it did so by booking new U.S. debt. It maintained its U.S. investments of $358 million US dollars and booked new U.S. debt of $5 billion US dollars. That gave it a net foreign exchange exposure on balance sheet of negative 4.643. That is to say, the U.S. dollar investments minus the U.S. dollar debt, giving a net translation foreign exchange exposure in renminbi translated at the balance sheet date of 6.2164 renminbi per US dollar of 28.8 billion renminbi. That meant that if the US dollar appreciated by 3%, Alibaba would lose 0.03 times 28,862 million, or 865 million renminbi. Alibaba has shorted the US dollar on balance sheet. What that means is that if the US dollar goes up, Alibaba loses. If the US dollar goes down, Alibaba gains. Now perhaps it's not just a straight bet. Maybe Alibaba anticipates that in future it will be getting US dollar revenue coming in. In that case, Alibaba has booked a balance sheet hedge. I want now to turn to transaction exposure. Stephen Roth in his text says that transaction exposure is short-run financial risk arising from the need to buy or sell at uncertain prices or rates in the near future. Note that Roth does not even talk about foreign exchange because he expands the scope of transactions exposure to the price risk of any asset, particularly of commodities like iron, steel, paper, gold, silver, or the products that are being produced by our company. But in my discussion, I'll be only referring to foreign exchange transactions exposure. The word hedging comes from a protective barrier made of wood or bricks or plants to prevent encroachment in a property. Here's a picture of a hedge around a house. Since the 17th century, so for at least the last 300 years, hedge has also taken on a financial meaning of protecting an investment from risk. The hedge does not change the underlying transaction that presents the risk. The hedge simply books additional cash flows that will offset the cash flows of the underlying risky transaction. Many hedges involve derivatives, such as forwards, swaps, and options, but hedges can also be balance sheet hedges, such as the one that I thought might exist for Alibaba. Because many hedges use derivatives, and because these derivatives trade in highly liquid markets, their cost, and by their cost I mean half of the bid-ask spread, so this is the bid-ask spread around the expected value of that derivative, typically the cost of this derivative tends to be low. So hedging can reduce the volatility of cash flows for a relatively low cost. A natural hedge is an offsetting operating cash flow, a payable that's arising from the conduct of business. A financial hedge refers to either an offsetting debt obligation, such as a loan, like we may have had with Alibaba, or some type of financial derivative, such as a foreign exchange forward contract. Corporate treasurers may wish to hedge because the predictions that they have of foreign exchange rate changes are poor, so you can often get it wrong. Hedging can increase the value of the firm simply by reducing the volatility of cash flows. That makes the firm less risky to investors. And hedging with forwards and swaps tends to be, as I said, relatively cheap. But corporate treasurers can also wish to speculate. They may wish to speculate if they're good at predicting the future, and if the corporate treasurer is fairly risk-loving or is not too risk-averse. Corporate treasurers want to add value. Most companies' strength is not finance, and they should not be encouraged to play in the markets. Yet large companies have corporate treasurers that do have expertise in financial markets, and in order to motivate these high-quality individuals, they may give them discretion to take financial risks for an expected return. For example, they may wish to take open positions on foreign exchange where coverage is expensive and perverse relative to forecasts. Or they may wish to make long-term bets on exchange rate movements based on macroeconomic analysis. Here is a simple example of hedging a transaction. You're a treasurer of a US-based multinational corporation and you expect that you're going to receive Japanese yen 10 billion inflow in 1 year. That's a contracted Japanese yen inflow. Your home currency is US dollars. You have no opinion on what the expected future spot will be, but the spot rate is 0.8333 US dollars per 100 Japanese yen, and the forward rate is 0.8706 US dollars per Japanese yen. So it's your direct quote on the Japanese yen. To analyze the problem correctly, first you should quantify the risk. Here is the Japanese yen per US dollar path from 2010 through to 2015, and you can see that it has fluctuated quite a lot, going down to almost 75 yen per US dollar and up to 125 yen per US dollar. So clearly there is risk within this transaction. How do we measure the risk? We can use simple statistical techniques to do so. We can calculate the standard deviation of the returns of the exchange rate. Again, here is the path of the Japanese yen per US dollar from 2010 to 2015. Here is where that path came from. This is the direct quote from the Japanese perspective on the price of US dollars, and these are the dates starting from the 10th of September 2015 and working back to 2010. Here are the calculations. At the top we have the daily standard deviation, which is simply the sample standard deviation of this vector, and here is, so that is 0.39% per day, and here is the annual standard deviation. We just take the daily standard deviation and multiply it by 250, that's the number of trading days in the year, to the power 1/2. Note that over the period, the yen has appreciated by 9.53% per year. So we've quantified the risk by saying that I'm going to assume that there is no expected trend. That's what the corporate treasurer believes. And I'll simply plug the standard deviation, this is the annual standard deviation, into a normal distribution, multiply it by 1.65 standard deviations, and that gives us 10%. That's to say there's a 95% probability that we will not lose more than 10%. Yet 10% of the principal amount is not trivial. By booking the forward, we would sell Japanese yen 10 billion forward. In 1 year, we deliver the Japanese yen 10 billion and accept US dollars 87.06 million. The advantages of the forward hedge is that it's usually cheap in terms of transaction costs, and the forward pricing tends to reflect the market forecast. This is the conclusion from the last lecture, that the forward price is an unbiased predictor of the future spot. Clearly, if the forward trades at a premium, but we expect no change in the future spot, it's much better to hedge. In this case, the forward was trading at a premium. That is to say, we received a higher valuation for the Japanese yen by booking the forward than the spot. These are US dollars per Japanese yen. If we believe that the current spot was the best estimate of the future spot, it's much better to hedge than to remain open. If the forward is an unbiased predictor of the spot, and transactions are not very costly, and we are risk averse, we should hedge. Remember, there's a 5% probability on this transaction that we would lose more than 100 million yen worth of US dollars. But if the forward is at a discount and you disagree with the forward forecast, then you should consider in detail the volatility, the forecast, and your risk aversion. In conclusion, foreign exchange movements can cause considerable changes to accounting statements and to cash flows. The risks should be understood and the risks should be managed.